After high school, college students experience many significant changes, including moving away from home, establishing new acquaintances, and arriving at classes on time. Amazingly, this new generation of adults has no time for anything else, much less investing and making money, given everything they have to deal with. Surprisingly, college is one of the finest places to begin investing if you desire financial freedom. Even those with a small amount of money can start developing a portfolio, which may be advantageous since you can learn how to invest and deal with unavoidable losses without losing a significant amount of money. Welcome to your personal finance channel, Finance Professor. In today's video, we will share a few investing strategies with you to make money and build general wealth. Don't forget to subscribe to our channel if you haven't already. College can be one of the hardest times to find extra money for even the necessities, let alone the things you want to do. However, it only costs a little money to start investing. With so many free or inexpensive options accessible today, a small investment of $20 or $30 will get you started. But more crucially, it makes you consider investing. The hardest aspect of investing is coming to terms with whom you are as an investor, whether as a genuine owner of publicly traded firms or even as a trader of different cryptocurrencies. You should approach your investments with an owner's long-term perspective, occasionally assess market activity, and for instance, make decisions that appear to have a strong possibility of paying off. Learning these skills early on is beneficial when they are affordable. Although we typically associate investment with the wealthy, this is only sometimes the case, and probably because it made them who they are. Before creating their jobs, students should consider how they might use the investment to construct and safeguard their financial future. Let's discuss a few ways for college students to begin investing, ranging from the safe to the daring. Number 1. Make a small monthly investment. If you choose a commission-free broker, you can make little monthly investments without having your capital drained by fees. As a result, more money is invested in your stocks or funds. Even with just $20 or $30 saved each month, you may see the money working for you in the stock market. Investors can now purchase fractions of shares through several brokers. No matter how the economy is doing, it's crucial to start. You will probably be more inclined to follow the market if you have even a small amount invested. You can also begin to see yourself as an investor. Investing money also motivates you to do research and evaluate your possessions. As a result, starting small and consistently can be advantageous. Number 2. Invest in an S&P 500 index fund. Purchasing an index fund is one of the simplest ways for a beginner investor like you to get started. Many of the most well-known index funds are based on the Standard & Poor's 500 indexes of large American corporations. In the case of the S&P 500, an index fund holds hundreds of shares of each stock in the index. The fund is extremely diversified since it holds so much firms in so many different industries, and as a result, it often provides less volatile returns than buying individual equities. Another benefit is that you only need a little knowledge to get started with an index fund. An S&P 500 index fund purchase is equivalent to purchasing the market, and you will receive the market return. It's a terrific approach to understanding how investing works, and famed investor and billionaire Warren Buffett advises it for most investors. Number 3. Consider starting with a high-yield savings account or CDs. Opening a high-yield savings account is one of the easiest methods to enhance your personal finances. These accounts permit withdrawals at any time while paying interest on deposits at rates much higher than those offered by conventional savings or checking accounts. The rates offered on these kinds of accounts are also at their highest levels in years as a result of an increase in interest rates generally. Bank products, such as high-yield savings accounts or certificates of deposits, CDs, are investments even if many savers don't think of them that way. They also rank among the safest choices available. With CDs, you commit money to the bank for a predetermined period of time in exchange for a fixed interest rate. These investments can serve as a fantastic holding area for cash you won't require until a specified future date. For instance, if you have money set aside for next year's tuition, you want it in an extremely secure account where the value won't change along with the stock market. For just this kind of need, a CD works well. Number 4. Register with a robo-advisor. You can use a robo-advisor if you need more time to choose specific equities or even an index fund. A robo-advisor automatically builds a portfolio for you based on your time horizon and how aggressive you want to be with your investments. Even $20 can start a beginning investor, and you can add money progressively without further transaction expenses. While some waive the fee for small accounts, robo-advisors often charge a percentage of your assets, typically 0.25% yearly. Two of the more popular robo-advisors that fall inside this price range are Wealthfront and Betterment. Though any funds you invest in often charge fees based on how much you own, you won't typically have to pay any extra money to the advisor. Additionally, you frequently receive advantages from the advisor, such as competitive interest rates on cash accounts and typically no lock-in requirements. Number 5. Open an IRA. You can come off as premature by considering an IRA while still in college. But if you're generating money through a job, as many students do, an IRA can be a terrific way to increase your future savings. You can save money on taxes by contributing to an IRA, deferring taxes on any gains or dividends, and deducting your contributions from your taxable income. Additionally, the sooner you begin investing in a tax advantage account, the longer you may use compound interest to maximize your account. Another excellent method to begin investing for retirement is through a Roth IRA. Because Roth IRA contributions are made with altered tax money, there won't be any immediate tax savings. But withdrawals made in retirement will be tax-free. While you're still in school and paying a low income tax rate, making contributions can save you money later when your income is taxed more heavily. Your investments will be able to multiply tax-free in a Roth IRA, just like they would in a standard IRA. Number 6. Turn to an investing app. Using an investment app is one approach to streamlining the investing process further. Stash is a well-known mobile app that enables you to purchase several individual stocks or a variety of ETFs, which may be helpful in this situation. The initial setup fee is $5, and the entry-level account has a monthly fee of $3. Stash can assist you if you need help knowing where to begin with investing, but want to learn and do it yourself. Acorns is another well-known investing app that made Bankrate's list of the best investment apps due to its simplicity. You add a debit or credit card to Acorns, which then invests the difference in one of several ETF portfolios after rounding up transactions to the nearest dollar. Acorns provide an all-inclusive base membership for $3 per month and a family membership for $5 per month. If you still need to get ready to participate with real money, you can practice buying and selling without losing money by participating in virtual trading. The most crucial and urgent advice for college students who want to invest is to get going immediately. You can start planning for your financial future as soon as you learn about the market. Students might start with minimal budgets and work towards expanding their knowledge and portfolio. Remember that it makes sense to take a cautious approach when you're starting. In the case of a fall, going all in on a company or certain asset class is extremely dangerous and could result in significant losses for you. Most investments involve some level of volatility, and understanding how to manage the feelings it elicits is essential to learning. That is all for this video. We will be back soon with another informative video. Don't forget to subscribe, like, and share this video. Please activate the notification button to get notified when we post the next video.